Good morning! This is the Abundance Mindset Podcast. Sit back and relax as we discuss hot topics on how to handle and grow your business, self-development, and how positivity can bring profitability in your life. Here are your hosts, Vinney and Gualter.
Hi friends, this is Vinney Chopra from here in Danville, California. And you might be saying, hey Vinney, what are these over here? You know, I wrote this book a few years back, Apartment Syndication Made Easy. It became top seller. I came from India with $7 in my pocket. It says 500 million. It's going to be 1 billion very soon, very soon. I'm right at about 850, 900 million. And then I'm ready for the next billion. Actually, you will see that happening, 2 billion in this book also. The other book I wrote, which has been a very big positivity, has been my life. Always, I've been married 43 years with 2 children, and the beauty is to be positive, the mindset that can take you to all the places in the world. And that's the book that also became big seller. My third book, Senior Assisted Living, is coming. So do yourself a favor, go ahead and click the link below to get free copies, audio copies of these books, even printed copies of these books. Printed means digital, if you can't afford it. But I would highly recommend for you to get these or go to Amazon.com. Just go to Amazon. I got it in soft cover, in hardcover, in Kindle, in audio, also the Spanish version of this book also. So let's crush it, guys. I know you can be successful. I know you can do the kind of things that you want to do in life and have the streams of income and know how to really, educate yourself so that you could become a strong force in this world in real estate. I know you can. So take that step. Don't just be on the sideline. Take charge of your life. Take charge of your education.
Welcome back, Alchemists. This is Abundance Thursdays with myself and the great Vinney Smile Chopra. Vinney, I forgot to say, my name's Gualter Amrello, just in case. Vinney, how is everything in California?
It's amazing, brother, amazing. It's nice, sunny outside, but I just saw in my iWatch 54 degrees. Wow, 54. So winter is here. Hey, and the election just happened also, and the market went up 1,500 plus points yesterday. Mind blowing, 500-600 NASDAQ. So let's see what kind of 2025 we're going to have.
I like it. It seems people are bullish.
Now the Fed is going to tell us if they're going to cut more interest rates, which will be really good for soft landing. And that can fuel also lots of great activity in the real estate where you and I are quite a bit providently there.
We're going to continue scaling that real estate space. So it is relevant news, right? So the presidency is relevant news. Trump won by a landslide,
landslide. Yeah.
And I was watching the Democratic recap. This is something that was on Netflix, and it was showing some of the Democrats explaining what they think they did wrong. So for us as investors, it's a good listening. What the market voted for basically was their pocketbooks. They voted for their credit cards, their personal accounts, and even people who disagreed with the Republican agenda, they said, you know what, and it was right there on the ballots. I disagree with the Republican agenda down here. They voted for pro-choice, all these things.
Yes.
But they voted for Trump because they believe that he can get the job done for our economy. And we saw that in the stock market immediately, 14% up, 14 points up.
Yeah,
1400. So it's very exciting for us as real estate investors. So we have a real estate investor as a president. What a cool scenario.
Actually, I know the Republics are always great for real estate tax cutting and everything, and cutting down the government spending and things like that. Cutting the fat. I say that running the business lean and mean, just like we should be running our businesses very lean and mean. That's the way to really bring that cash flow, and that's what we're going to talk about today.
It's wild. It's so cool that this is the topic today. Wealth Principle 3, we're going to talk about this Saturday anyway, but we're getting a billionaire's perspective. Vinney's not a net worth billionaire yet, but he did come to this country with $7. He did raise $280 million worth of capital from investors and then bought $1.3 billion worth of real estate. And so, Vinney, if think a million is the first step, you already thought a billion. If buy a million is the first step, you bought $1 billion. So then the next inevitable step from being a millionaire is have a net worth of $1 million and then earn $1 million. So for you, it's have a net worth of $1 billion and then earn $1 billion. You're 72 years young. We'll just see how it goes, right?
Hey, life is just a number. I always say that. And I've been saying that all my life. 45 years I've been here, 46 years from India. I always say every birthday, tell your mind you're 1 year younger. And I've been saying that. When you say too many times to your subconscious mind, guess what happens? It starts believing. Please try that. It's so easy to, not easy, but it just gets into that. The subconscious and the conscious mind always are struggling with us in making decisions and forming habits. So if we can really, with the loud mouth, with loud signals, say that I'm younger, I'm excited, I'm enthusiastic, you will become that person, you know.
So today's principle is going to be, you're going to hear us talk a lot about mindset and thinking pattern, because we're talking about
Yeah.
the 4 types of money. And there are 4 very specific types of money. The first being income, the second being profit, the third being flow, and the fourth being equity, the one that
Equity.
makes us millionaires and multimillionaires and decamillionaires and pentamillionaires and 100 millionaires. That equity, so many people don't even know what it is, Vinny. And we'll talk about that in a little bit, but I just want to share with
Sure.
you that my brother, 4 or 5 years ago, before he bought his first rental property, he bought a big commercial building, 40,000 square foot. And he said to me, he said, "What's equity?" And I sat back and said, "No way. My own brother doesn't know what equity is. This is an important type of money, Josh. Like, you got to know what it
Yeah.
is." So we're going to go into the 4 types of money today. And as we go through it, you, the listener, just be listening to Vinny's mindset, the way he talks, the way he communicates about money itself, and these 4 different types, because they have a place in his head at all times. But for most people, they're just thinking about income. And in fact, Vinny, I'll even propose they're not even thinking about income. They're actually just thinking about flow, which is just the money that comes in and out. Money goes,
Coming in
how
and
much they
out.
need to
Yeah.
pay their bills. They're thinking about flow
That's
all the
right.
time.
Yeah. Yeah. So true. So true. And the cash flow, which is the number one, of course, we make cash or flow of the cash or money with the W-2 job. We always say that it's a security. It's something we got to put that 7, 8 hours. And it's great. It's awesome. And we need to be getting higher and higher pays, because if we set up our mind that we are worth more, see, that's the trouble. Many times we don't reach the next level if we don't say to ourselves that I'm worth more. That's how millennials change jobs a lot more than baby boomers and so forth, like that. Older thinking and everything, more security. I remember when I started with $10,000 a year, I told my wife I'll make $50,000. This is payback. I got married in 1980. She says, "Are you sure 5 times?" I said, "Yes, honey, you see me." See, once you set your mind high, then things happen for you. That's the other part. We let people just stop at the success door. I say we don't open it, but we should do it. The second part is we need to have a side hustle. How can we have more cash flow? It's W-2 plus the side hustle. Side hustle can be a business, entrepreneur, semi-entrepreneurship, could be an LLC, could be any kind of business, right? Franchise business, whatever. Wherever your interest lies, start a business, because that's going to bring cash flow. So cash flow comes from investments, from businesses, from side hustles, and our income.
And as you're listening, I know we're going to use a lot of words transferably. So I want to set into, you and I, Vinny, can stick to this. Income, we'll talk about that as
Yeah.
just active income. We'll just talk like
Yeah.
income is passive income also. So there's income that you worked for, income that came in passively. And then profit is what's left after expenses in a business.
Yes.
So going forward, if you hear Vinny say the word cash flow, what he's talking about is profit. It's money that we get to
Profit.
keep. It's
So
money that
true.
stays afterwards. Income, which you was just talking about, is money you earn, or it can be passive money. It's money that comes into the business. It's just the top level. It's revenue. It's that top gross amount. And then flow is the money that has to be spent. It's the money expenses every month are $5,000 a month or 50. One of my businesses, the flow is $20,000 a month. In fact, my rental property business, when I had, what was it? I think we had 60 units, and our
Yep.
flow every month was $30,000 a month. Every month flow was mortgages,
Hmm.
taxes, insurances.
Yep.
And
Yep.
we could probably even talk about one of the RALs you have, right? So that we know the management of that, we know the taxes and the building and the expenses
Sure.
are flow. And then, so that's just money that just always has to be in the account. And then there's equity, the magic component of the difference between their value of your asset and the debt that you hold on it. Vinny, if you could explain before we go back into income, because everybody wants to talk about how do I make more money, and before we talk about making
Yes.
profit, and before we talk about the paying the bills, can you just magically explain equity? Why equity to me is so magical? Why is this guy think it's magical? Why?
Ah,
How did it build your wealth?
equity is the name of the game. What that is actually, when we put down payment, we do closing costs and things like that. When we purchase a real estate asset or stocks or anything, you are putting some money down. Now the value of that asset increases, but the residents are paying down the balance of the loan from the institution. If you're getting a real estate, if we bought $1 million and the institution gave us $700,000 loan, and we over the years we'll be able to increase rents and amenities and everything. The NOI, net operating income, total revenues minus the expenses, is called net operating income. As that grows, divided by the cap rate of that set, it could be business cap rate, it could be real estate cap rate, right? Any kind of thing. So the value increases. Now, when we say the value increases from 1 million to 2 million, but the loan has gone down, maybe 600,000. It's not 700 anymore, it's 600. So the value, the equity growth, we call it, is the difference of that, the 1 million extra minus the 100,000 lower the mortgage. So 1.1 million is the equity growth. Now, let's remember, we did put money down. So that equity, whatever we put down, has grown into such a beautiful return on investment, which is equity gain.
So for each of you who's listening right now, and by the way, Vinny,
Mhm.
excellent example. I love that you also included the debt pay down, the amortization of the loan, because I don't always include that when I'm
Yeah,
talking about it. So that was a
yeah.
little more depth. A person could invest $300,000, and because of equity,
Mhm.
that 300,000 became 1.4 million because you added the 1.1
That's,
plus the
yes.
300. So 300,000
Yeah.
became $1.4 million. That's the magic of equity based on appreciation and amortization, pay down of the
Mhm.
mortgage and appreciation of the asset because of forced appreciation. In fact, you didn't even talk about the market going up. You just said raised
No.
rents, we improved our expenses, and we were able to get this access. Now, this is something that's important because you have taught this your entire career. As a syndicator, you're not giving
Yeah.
away just interest because interest would only be income. Interest would only be
Mhm.
like an income-based challenge, which doesn't
Yes.
give an investor exposure to the market or exposure to forced appreciation. So one form of appreciation or amortization of the loan as well. So your investment strategy actually allows a person access to equity, which makes it different
Yes.
from the bank, which does not give you
Yeah.
access to equity. They just give you interest.
For sure. What you're saying is so right. When we put our money in the bank, they're going to give us the interest on that money, 4%, 5%. CDs are there. Of course, we buy stocks also. Let's say we buy stocks. You have to pay the full price of Google stock to buy that. And when it goes up, you make interest on that or gain. We call it gain in that stock. In real estate, the beauty is the leverage. Leverage is something that we just don't really think about many times. That's why a lot of money in retirement funds and all flowing into real estate or any kind of businesses is you're putting a little bit money down. For example, if we put 100,000 down and we got 75 LTV, loan to value ratio, with the bank, now you're getting an asset worth 4 times because the bank came in. You're not really controlling 100,000 of your investment, but you're controlling 4 times that, 400,000. And that set is going to increase at the 400 to 800 maybe. right? Not the 100 will go to 800, but 4. So the leverage is the key right there, which we sometimes miss. The other part is that investors need to be your partners. Syndication, the word is like-minded people getting together to pool the money together for a common cause, which they like it, and then sharing the profits will be not only the cash flow that the asset is giving, but the gain of the value also. That's why in my life, I've been doing it for 18 years or whatever, and my investors get 80% and 20% the GP and the LP get 80, or 70% the GP LP gets, 30% the GP gets, right? So what we are working on a daily basis, we find the deal and we do everything. We do underwriting, we do due diligence, we manage the asset, we sell the asset. We are working 70% of our efforts are working for the LPs. So it's a good thing because otherwise I wouldn't have been able to buy $64 million deal. That will take me how much at 30% down? That's $18 million. Right? But
Right.
to raise the money, so the investors are a very important part of the equation in
And
making the cash flow and equity gain. Yeah.
as I'm listening, I'm just thinking like a lot of the deals I've done when I've brought investors in, I've always brought them in as debt partners. For me, I was always
Yeah.
keeping the equity. And so I bring in my investors and they'd get 12%. That was always my standard payment. 10, 12, 10.
Mhm.
Yeah, if I get
Yep.
8, I would, but most of the time it was 12 and 8, 12 and 10. And I realized, and I still do this. So I want to be very clear.
Yes. Yeah.
I
Sure. Why
still
not? Why not?
prefer to keep the money. But there are
Hmm.
times where I look at my portfolio and I think, wow, like I also lend. I lend at 12%, I lend at 15%. So that's a part of
Hmm.
my portfolio that I absolutely love because it's just very steady. But I have
Yep.
to also I have a bigger chunk of my portfolio exposed to LP deals and other people's
Hmm.
investments. And
Hmm.
in my own personal investments because of that equity component. Because
Yeah.
if we don't
Yeah.
have equity in our portfolio, we end up with slowly over time growing broke. We're getting income, but the dollar's getting inflated, right? The dollar keeps
Yeah.
getting inflated, so it buys less and less.
Hmm.
So
Hmm.
equity, I was just on a call with a woman who has a wonderful pension from the government, but her income stays the same because she's locked
Ah.
into the dollar. She doesn't have equity and assets. And she did
Hmm.
have equity in that. She did have real estate. So that was what allows her more opportunity to passively invest. And so to equity, I think we hammered equity pretty hard. It's just one
I
that
would
builds
like to.
people,
I'd
right?
like to mention, like there are, as the seniors, as the baby boomers are turning 65, 10,000 plus 11,200 a day now. The key thing is it depends on the profile of the investor also. Many investors, as they're growing older, they may not like the equity play. They may like to get the good cash flow right now, which they needed for living expenses and everything. So there is a hybrid also, which you're doing is great. But at the same token, lots of the millennials and lots of baby boomers and all, they know the game outside and they want to be a part of the gain of the equity. So there is a model for every investor. LPs can have straight 10 or 12, like you are saying. I'm doing that too, by the way. And then I also love the fact that when I do hybrid, 70/30 in construction, actually even 60/40, because the profits are so high in the developments and so forth. The key thing is you got to be able to share the pie so that everybody wins. See, I wouldn't have been able to raise 220 million plus if I didn't have the model of equity gain, because investors are very savvy. They want to make sure they are buying the building with you. So they want to take part of the gain, which is fine, which is totally fine. And that's
As an
how
investor,
the
that's what I want. Yes, totally. So
but
this is good. So you
yeah,
just actually hit on income, right? I hit on
mhm,
income and you just hit on income as we get older. And
yeah,
even some of the deals that we do have, where there's an 8% pref, where you're getting paid 8%, it doesn't always happen, right? Sometimes you
mhm,
end up investing in things where that just isn't possible for a
yeah,
year or 2 years during stabilization period.
totally,
It
totally,
does make sense to have income, right? Whether it's active income or passive income, sometimes those notes make sense. And I love my notes. I have them and I think they're wonderful.
yep.
I like the stream of income. It's very consistent. I don't have to worry about it. But I know
Yeah.
it's not growing in equity. So I just want to share as we're going through understanding the four types of money, there is no one that solves all the problems.
Yeah. Yeah.
You
That's the
want to
thing.
have a nice mix. And so let's talk about income just a little bit because I know most people I have met over the last year speaking on stages and at the summit, a lot of people are very focused on increasing their income. They just make more income. What are some of the benefits or what if you could just describe why is income so important to the equation? Like why is that so important to
I'm so glad you're saying that because see, income fuels savings and the savings fuel more investments. That's how the whole equation works. If you're having a W 2 income, we say salary or commissions and bonuses like that, and then you have a business and that brings income, now you are having this pool of money that you would like to invest so that it makes the equity bigger. Then you refi, we call the waterfall refi, because debt equity is no good equity. Aha, that's a good thing right there. See, if you have lots of $2, $3, $4 million staying in the equity, and the market also goes up and down, by the way. All the emerging markets don't stay all the way to the top, they come down. That's why I try to sell with 3 to 5, 6 years, because we have gone to leave some profits for the new buyer so that they could make that. Then there are IRR reports, there are all these, because each market is cyclical, we call it. So we have to keep that in mind when we take that equity out in a waterfall by refi. Now you could use that money to pay the loan back or the investor's money back. Now they got their money back, they can reinvest with you into new deals in other emerging markets. So it's a beautiful thing once you understand the whole psychology of how to buy, sell, and then hold it and then reinvest again. That's what it's all about.
what you just said, Vinny, and so for everybody who's listening, he said dead equity is bad. I know
Yeah.
sometimes it's easy to think equity in a property is a good thing, but dead equity is the equity just sitting there not getting a return. That's where the
Yeah.
ROE equation comes from, return on equity. If you have
Equity.
$1
Yeah.
million in equity and you're pulling in $100,000 a year, cash flow, passive income,
Mm-hmm.
cool,
Mm-hmm.
10%, great. But if that property goes to $2 million in equity, or let's say the property it's a
Yes.
$10 million property and it just goes up 10% over 2 years, now you got $2 million in equity in it. Now you're getting 5% return on equity. And let's say that happens
So
again,
it's
a few more years
mhm.
go by and this thing goes up. Now it's $3 million in equity.
Yeah.
Now you're at 3%, 3.5% return on equity. Now you're getting it's dead equity. You're getting no money for the amount of equity sitting there. What is how do you know that, Vinny? Like how do you
I would say, I'm so glad you're saying that. It was in my mind. We should talk about profile, risk profile. See, the LTV is based on equity and debt. So, loan to value, you definitely want in a uncertain market, LTV should be as low as possible. Aha. The lenders also, the banks also will give you better rates. Everything, if you're putting 40% down, 35% down. I have bought deals at like 17% down, right? In certain places, even 10% down, 10, and like that. But in good times, you got to be really looking at what deal you have, each deal specific, where your underwriting should be very conservative. See, that's the problem. Many times we mess around with these numbers, and by putting wrong numbers, we can come up with some inflated returns, and that can hurt us. We need to be very judicial and underscore what we our assumptions are, not to take too much interest in the increase in rents, or we do the value add. We need to do more comparisons of the properties around so that we are not taking the cap rate as, hey, we're going to go way down in cap rate. When the cap rate decreases, the value shots up many multiples. So you have to be very careful. All those. So the risk profile of any investment is very important. It's the savviness of the operators who are at the top, how much track record they have, what they have accomplished, and so on.
and driving that bottom line, maybe not the
Yes.
bottom line, because the bottom line that would be profit. So before I get to the bottom line, driving
Mhm.
the top line, income, right?
Yes.
So I'm in a
Yeah.
refinance right now that I'm doing in Decatur, Illinois, and my banks are like, we need to see you at $24,000 a month gross income,
Ah.
because they
Uh-huh.
want to see that we're getting that DSCR. What is it? DSCR. So that they want to
DSCR,
see that
yeah,
our
debt coverage ratio. Yep, yep.
yes,
Uh-huh.
they want 1.25%. And so
Yep.
so for each of you who are listening, just ignore all that. It doesn't matter. But there's going to be a time where your revenue has to be a certain number, because
Yes.
if your bills, the goals you have are $24,000 a month, you can't earn 22. So your
Yeah.
revenue has to get past a certain point in order to have even the capacity. So if you're looking to
Wait.
spend 50,000 a month, you can't do it on a $20,000 a month income.
Right.
There's a revenue component to it. I know most gurus will tell you it's not about how much you make, it's about how much you keep, but there is a component of making that is necessary.
Yeah.
And filling units and getting occupancy is
Ah.
different from cutting
Oh,
expenses, Vinny.
I am so glad you touched that in my mastermind last night. It was so ironical. We were looking at this, I think 50 units or 32 units property in Louisville, Kentucky. It was so interesting to see the revenues coming in as we dig into the P&L, bad debt, and that was a large number in the P&L. That tells us that the demographics of that asset, it was 97% occupied, by the way, but the revenues coming in, but a big chunk going out in bad debt and writing off. People are not paying that. That just threw a big red sign right there. The other part was like, how much more can we increase the rents? This property is built in 2020. Yeah,
Oh, okay.
just for 4 years back. Wow.
Brand new
And
building.
you very new building. And the interest rate is 1% because it's affordable housing. And it's for 15 years, 1% only, and so forth. But we started analyzing all the different things and where the area was and everything. And we walked away.
You couldn't go
See,
any further. There was nowhere to increase the income.
that's the thing. And then we found out even the utilities bill back, RUB system, we couldn't do it. You got to always be looking at a business plan. What you're going to do when you buy the property first day? What's your plan to action? Is it really sending out the letters to the residents and say, we are the new management, we want to do amenities, will be more, we'll be rehabbing some of the units, all that, right? We'll make these apartments smart home, we call them, with the links and the outlets, right? USB outlets and all that. But the other part is the utilities bill back is huge. RUB system, ratio utilities bill back system, which is charging for water, trash, gas, and termite back to the residents as they were owning their home. And a lot of time people don't charge because they want to, that the owner is paying. So their
Yeah.
rent is actually lower than what you're collecting. Yeah,
And that happens a lot in
yeah.
C class, B class properties where the owner
Yeah,
takes the water bill, takes the gas, electric, something. C class for sure is gas.
yeah,
So
yeah,
that is, we talked about revenue, and now we're just actually starting to slide right into profit, right? Profit is a
yeah,
direct result of your ability to cut down those expenses. So if revenue is taken care of, if
yeah.
income is taken care of, now you have you jack that up as high as you can. What's the next function you have? That's profit. Can you get those expenses lower? What are some of the
See,
expenses that you look for in a property to see an opportunity? What would be a ratio? Because I know we look at the 50% rule as an expense ratio that probably is going to,
so totally. 50, 55. When we buy the property, that's a bad management. Could be also the rent increases. That's a good sign that we could increase the rents, like the one in Knoxville, Tennessee. We were able to increase the rents like almost double because we saw the comparison properties, right? It took us a year and a half to change the demographics and all that. But the big thing is you got to look at the revenue increasing and decreasing expenses, taxes and insurance, major ones, property taxes and insurance, as you're buying at a higher price than the base of the seller who might have bought it many years back. So you want to put the new mill rate and everything to calculate that, right? Then the management of the property, who was managing it, how much percentage you'll be paying to the new and the salaries. You want to make sure that the leasing and everything is done and marketing. So those expenses, if we can really be straight in the realistic, look at everything, then you come with NOI, net operating income. Is it higher than what the seller is showing in the P&L? That's when you implement the system, increase the NOI more, and now you take out the interest and the principal down. CapEx, you got to also put the CapEx. Many times people forget CapEx. That's the worst thing can happen because your profits will be after the NOI, after the interest and the principal. If it's interest only for 2 years, that's great. Minus the CapEx, then comes the net income, cash flow, we call it, that you take it to the bank. Now, a lot of people ask me, Vinny, what should be the cap rate of an asset? I said, you know what? You can never take cap rate to the bank,
Yep.
deposit it in your account. It's the cash flow, the net income, bottom line, every month on the month goes into the account. That's what gives out to the investors and yourself.
It's so good. I use cap rates to submit offers, but cap rates you can't take those to the bank. The bank doesn't care about the cap rate. They care about how much money you put in the bank, and
Yeah,
that's the
yeah,
story. So that brings us
yeah.
to the final one. Flow
Oh,
is
yeah,
those expenses you just can't change, right? That
yeah.
minimum amount you need to have in there. What are some flow factors to a rental portfolio? As you're acquiring 200 units or 300 units, what are some flow factors that are always going to be there?
I'm so glad all these expenses, which are major cash flow, you have to pay the mortgage, interest, principal, taxes, insurance. You got to pay those by the 5th of the month, right? 6th of the month. That's number one. If you miss two payments, the lender is going to come after you, right? Foreclosure in third month. So that's huge, those big expenses. Then comes salary, because if you cannot pay to the leasing agent, community manager, and all, then they're not going to be excited and everything. So that's
You
their
just phrase
bonus.
that. They won't be excited.
They'll give up. Then marketing comes after that. So you got to make sure you're really savvy, your inflow is coming. Occupancy is huge. You got to make sure that every week you're on target to use the occupancy as a, and not only that, occupancy today, occupancy in 90 days, because we like to look at the report of the residents who have given notices to vacate. They have to give 30-day notice, 60-day notice, like that. So you have to look at all those KPIs to make sure that we rev up who is going to be coming in when they leave, and then how much is going to cost us to make ready, it's called make ready for the apartment. So all those things are very important, right? The biggest thing is in the CapEx, to get wholly involved as a one person in your team or yourself, like myself in my as the CEO. I save millions and millions of dollars in negotiating contracts, getting three bids, and then bringing them to the same plan of action or work, and then asking them to go down and go down. If the urgency is not there, they'll figure out to go down 30% many times when they are not that busy. See, if the urgency is there, you got to pay top price. If your parking lot can wait, I remember I say that 670,000 bid, I got it done for 149,000 over the weekend. It was so interesting on Albion Apartments over there in Texas. And here I was dealing with this parking lot for almost a year and a half. And all these big companies gave me 670, then 330 bid, then even I think 270 bid. And then when I had to get it done, I got it done for 140, 140 or something like that, 139 or 40. I
You
just
had a
paid one.
bid that was $500,000 more to its parking lot.
It's
Amazing.
mind blowing, and it was 2 inch thick. And my even the community manager, lovely Tiffany, she measured it with the inchy tape and sent me the picture. It was so interesting for me to see, and they even striped it for me as extra and everything. It's amazing. You can really, if you put yourself and you understand what the cost of goods are, what's the labor should be. This is many years back now, of course, but same thing with the roofing. Oh my gosh. I don't know how many thousands of dollars I saved on the roofs because you got to really know what's the cost of the roof and the labor and everything. And then when hurricane season, it's a lot more because a lot more people are needing them and so on. You try to position those things in a better way.
So you put the blue tarp on the roof for 3 or 4 months, and then you go do
Yeah.
the roof after hurricane season's over.
You don't want to spoil the apartments. I know flat roofs. I hate flat roofs. I think in 40 of my deals, I had only 4 flat roofs, maybe 4 or 5. But the thing is, the pitch roofs are the best ones. Yeah,
Yeah,
yeah.
I had a 10-unit building that had a flat roof on it, but it was
Oh,
a 4-year-old roof, and I sold it 4 years later, so I was fine. But I always
hmm.
was a little concerned about it because it's flat roof, snow. It's just not, they're not easy to maintain. They always leak eventually.
Yeah,
Yeah.
they do. They do. And you don't know where the leak is. That's the worst part. In the flat
It
roof,
could be
leak,
anywhere.
it could be anywhere, literally. That's the thing. And the lenders also don't like flat roofs, by the way, for that reason, because it costs so much to replace and everything. Yeah.
They are. I have this condo complex that I'm a part of where
Mm-hmm.
I own 50% of the condos in the building, and there's
Mm-hmm.
3 separate flat roofs. It's just they're
Ah,
they're like $50,000 and $80,000 roofs. Each one of them is expensive to
wow.
go and replace, but we don't have to do them yet. So,
No.
Vinny, what an amazing, I think this was property management 101. This was asset management 101. We really went through
Yeah,
how to make
we
sure an
did.
asset gets to the equity that you want to have, gets you the cash flow, and
Mm-hmm.
provides a good return for investors. Making sure that the flow of expenses and making sure you're increasing your revenue. This was really asset management. This was such a good principle. So, Wealth Principle 3, we're going to talk about again Saturday. We do this every single Abundance Thursdays at 9 a.m. Pacific Standard Time, 12 p.m. Eastern Time. Vinney Chopra has dedicated his time, the last decades of just training people since you started getting into this. Vinny, before we
Thank
jump,
you.
what is the easiest way a person could get in touch with you if they wanted to learn more about your mentorship or your mastermind? What's the best way for them to go?
Sure, just text me 925-766-3518. My team will reply back to you. We could do a Zoom, find out where you stand, what your goals are. You could go to vinneychopra.com/mentorship, or you could go to vinneychopra.com/free benefits. Love to have you read my books, 3 books that I have put together. My 4th one is coming, and then my podcast. And Brother Gualter and I do this show, Abundance Mindset, and Bo and I, Vinney and Bo show, I do it tomorrow, Friday, 9 a.m. So lots of great avenues to reach me.
So you heard it here. You can go to vinneychopra.com, find all the avenues. Cheers to your success. You have a choice. Always work with the best. I'll see you in the next one.
Hey there! The upcoming episode is scheduled for Thursday. We appreciate your viewership of the Abundance Mindset Show. Tune in every Thursday at 9 a.m. Pacific Standard Time or 12 p.m. Eastern on various social media platforms hosted by Vinney Chopra and Gualter Amrello. Don't forget to subscribe, share your comments, and leave a 5-star review. Thank you for your support.